Hello, everyone, and welcome back to Sipping Wealth Live. We are back to on for another Tuesday, where I go live, where I bring you news, tips, and tricks on how to wealth up. So today is a live Q&A. I had some people send me in some questions that they wanted me to answer while on the live. So I'm going to answer those. But if you do have questions while I'm live, make sure that you drop them in the comment section, and I'll make sure I address them. Make sure that you hit the share button so that your friends, loved ones, followers, all that good stuff can wealth up with us. And hit the subscribe button on the YouTube channel, Sipping Wealth. All right, y'all, let's get it popping. All right, so for starters, I'm gonna go over the questions that I've gotten from some people. Again, if you do have questions, drop it in the comment section. Also, if you're live with me, if you're tuned in, say hey girl, drop a hey in the comment section so I know who's with me. But yes, y'all, let's get it. All right, so one of the questions is, how do I determine whether or not I qualify for a particular credit or deduction? So with that, it's one, make sure that you go to a knowledgeable tax professional, because one, they're gonna know. Well, I hope the one that you go to, if you go to strategic tax, you have nothing to worry about. Hey. Um, but yes. So if to figure out whether or not you're eligible for a particular deduction or credit, one of the ways is to go to the IRS website directly. So you can do a search whenever you're searching for a particular credit or deduction. Go ahead and search it. For example, if I'm looking for the energy clean vehicle credit, maybe I purchased a Tesla. So I want to put, hey, is there a clean vehicle credit or is there electric vehicle credit into Google? And I want to put irs.gov next to it, so that I want to make sure that whatever site comes up, irs.gov is one of the websites that come up. So I can make sure that I look at it directly from the IRS. Because you know that, hey, if I go to another particular website, that box may not be up to date, but if I go to IRS directly, then you know you're going to have the latest information if you're looking at the most recent publication. Well, ultimately, you want to make sure that you're going to a knowledgeable tax professional that you trust. And with that also being said, um, and I think that was one of the questions too, but I'm going to address it. So, as far as who is responsible for your tax preparation, or if there's error or something left out of your taxes, the taxpayer ultimately holds responsibility for their tax return. So when you sign your tax return, you're essentially telling the IRS, all the information here is accurate, and it's based on my knowledge, my understanding, everything's here. So the blame, it does fall on the taxpayer, not the tax preparer. So you do want to make sure that you are going to somebody knowledgeable that you can trust, that's going to represent you in the right way, and going to give the right information to the IRS. The IRS is staffed, okay? So more than ever, people are receiving their audit letters. People are not even receiving their taxes on time. They're getting delays, all this stuff, because the IRS is looking at this stuff. They're staffed, okay? They're able to say, oh my gosh, hey, this person haven't filed, or this person has a missing form, or this person has an error on their tax return. Let's go ahead and find some more information a lot quicker than in the past, because they are hiring a lot more representatives. So, you want to make sure, like I said, the information on your tax return is accurate. You have the proof to back it up, and that you are going to a knowledgeable professional and someone that you trust. The next question is, what's the difference between a tax deduction and a tax credit? So, a tax deduction is going to decrease your taxable income. Now that's going to essentially, if you made $50,000 for the year, after your deduction is going to go down, and say you have $20,000 in deductions, your income is going to go down to 30,000 because of those deductions. Now, a tax credit says, oh, you have a tax bill. Say you owe the IRS $5,000. Then, based on the credit, it brings, say you received a credit for $2,000, it brings down that $5,000 bill to the IRS down to $3,000. So that's how credits work. Credits are decreasing your tax bill, deductions are decreasing your taxable income. So hopefully that's helpful. That's probably like the simplest way that I could kind of put it. Um, and then you do have like non-refundable versus refundable credits, depending on, you know, if you have a tax bill or not, things like that. All right. The next question I have is, what is a standard deduction? Okay. All right. So, standard deduction is essentially a deduction that the IRS gives. It's a common deduction based on your filing status. So, based on your filing status, the IRS says, "Hey, we're going to decrease the amount that you're going to pay taxes to us on based on your filing status." So, for example, last year was 13,850. So, your IRS bill, your say you earned $50,000, back to the $50,000, and the standard deduction is that $13,850. It brings that $50,000 down to, I got y'all. Uh, 36,000. So now $36,000 is what your taxable income is. So that's the amount that you're actually going to be taxed on. All right. So that's after your standard deduction. Hey Keandre. Hey girl. I don't know if there's a question in there or something. Hello. Hey. Thank you. Thank you. Blessings to you as well. I appreciate that. Thank you. Y'all, if you're tuned in, if you have questions, let me know. Drop your questions in the comment section. Um, yes, I sent stats. Stats. Oh, stars. Oh, okay. Thank you. Thank you. Appreciate it. Thank you. Oh, okay. It came in as a blank. Okay, I see. I see. Thank you. Um, Okay, I entered standard deduction. Okay. And then whether or not you should take an itemized deduction or standard deduction is going to be based on whether or not your qualifying deductions are higher than your standard deduction generally. So if you have, say, your standard deduction is $14,000, but you have medical bills, you have property taxes and charitable contributions, that's $20,000. So you want to go ahead and take the itemized deduction because your itemized deduction is higher than your standard deduction. Now, if you're married, you have to do, and you're filing separately, then you have to do whatever your spouse is doing. So if your spouse takes in standard deduction, if, then, and you do an itemized deduction, then that other spouse has to amend their taxes and they have to do an itemized deduction as well. But say if your spouse, hey, before you file, you talk to your spouse and y'all filing separately, and that person says, hey, I did an itemized deduction, then now you have to do an itemized deduction. Now, say your itemized deduction is $4,000. Even though it's lower than the standard deduction, you still have to take the itemized deduction because your spouse did an itemized deduction. Okay. So that's the kind of caveat with doing the standard deduction versus the itemized deduction. All right. Um, what are some ways that I could lower my tax bill? Come on, y'all. That's a general question. So there are tons of ways. I'm gonna reference all the lives that I've been doing throughout the year. We are I've done one every week since the top of this year. So you have tons of tips, different ways on decreasing your tax bill, different strategies, things like that. Check out the Sipping Wealth YouTube channel and go through the other videos as far as decreasing your tax bill. There are taking advantage of credits, taking advantage of deductions, are going to be your huge savings with your decreasing your tax bill. I know that's kind of a blanket statement, but with decreasing your tax bill, it's really depending on the person's situation. Because if somebody comes to me and they're like, "Oh, I'm a W-2 earner. I earn and and I own a real estate property or a property and um and I have no children and I'm a single filer. How can I decrease my tax bill?" Now, I'm going to say, "Hey, that property do you own? Is it a primary resident or do you rent it?" "Oh, no, it's a primary resident." Well, something that you could possibly do that you may have not even thought about is renting a room in your home. So once you rent out the room in your home, that square footage is now a business. So now you get to write off write off the deductions associated with that space, as well as a portion of your electric bill, a portion of your phone bill, a portion of your maintenance, any repairs that you do to that room. Now, if the person that's renting the room also uses other spaces in the home, they're writing off different portions depending on allocation. So, hey, that's something that you may have not even thought about is renting a room in your home, and that could just be and that could go ahead and help with decreasing your tax bill and taking some of those deductions. That's just something small. Or maybe saying, "Oh, you just purchased this car, this energy efficient car last year. You can actually go ahead and take advantage of that tax credit, the clean energy clean vehicle tax credit." Different things like that. So like I said, as far as lowering your tax bill is going to depend on the person's situation. It's situational. Um, so that's why you want to make sure that you actually sit down for a tax strategy, get one, and as close as in the beginning of the year as possible. Okay. You don't want to wait until the end of the year and say, "Oh, I'm ready to try to decrease my tax bill." Well, a lot of the things you can't even take advantage of anymore because you just let the entire year go by. So it decreases the amount of things that you could take advantage of to help decrease your tax bill. So we're in the top of the second quarter. If this is something where you're like, "Oh my gosh, I need to do," or "I'm tired of paying all these money and taxes," then you want to make sure that you're actually getting in touch with a tax accountant, sitting down for a tax strategy, and following what the recommendations. Um, Question: how do I track my business expenses? All right. So with this, tracking your business expenses, one, you want to make sure you have a separate account from your personal account for your business. So you do not want to mingle your personal expenses or income and your business. You want to make sure that they're separate. All right. And then on top of it, you want to technology's here, y'all. Like here to make your life simpler. So how do you track your business expenses? You can go ahead and get a software. Get FreshBooks. Get these other little softwares to help you with it because you can sync your bank account to it, upload your receipts to the software, track your mileage to the softwares. Like there's softwares out there to help you. Now, if you're like, "Ooh, I don't want to spend the money on a software," then something you can do is maybe an Excel sheet. Every trip that you take in your vehicle for business, you want to make sure that you go ahead and document it. You want to take your odometer reading at the top of the year and your odometer reading at the end of the year. And you want to go ahead and jot down every trip that you make with your car for your business. Another thing is outside of mileage with other expenses. I say really a hack is to use your Google Drive. So if you instead of keeping a bunch of receipts, so if you went out somewhere, somebody hands you a receipt, go ahead and get your phone and take a picture of the receipt, put it in your Google Drive, and you don't have to keep, keeping all these physical receipts. And that's another way that you could track the receipts and then get the and business expenses. An Excel sheet, a tax accounting software, a bookkeeper. If you're in business and you've been in business for three, two, three, or what, 3, 4, 5 years plus, and you don't have a bookkeeper at this point, then you're stunting your company's growth. You're spending so much time on the tedious, mundane things like bookkeeping, you're not focusing on how to scale the business. And you're shooting yourself in the foot because you want to save money by not getting a bookkeeper. But you're spending time that you could be generating more money on doing bookkeeping. So get a bookkeeper. Um, our bookkeeping packages start at $250 a month. Get a bookkeeper. Then you could spend all that time figuring out how to get these bigger clients, the more quality clients. Go to networking events, go to conferences, go wherever where you can scale your business, move it to the next level, versus sitting doing reconciliations because you don't want to spend the extra money on bookkeeping. You rather stunt your company's growth. All right. The next question is how do I handle depreciation? So with depreciation is correlates with the particular asset. So depending on the asset is going to determine how long you can depreciate it for. So for example, a residential house versus a commercial real estate, it's either going to be 27.5 years or it's going to be 39 years if it's commercial. So and that's going to say if the home is $300,000 and it's residential, it will be split up across 27 years. 27.5 years. Now, if it's a commercial building, then it'll be split off across 39 years. So it's really dependent. Maybe you have startup costs. Maybe you had to spend the first 2 years of your business pouring in money and you didn't earn income until the third year. All that money that you were spending on the business in year one and year two, like keep track of that stuff because now that's startup costs. So say you spent $50,000 on year one and year two, and now year three, you're finally generating money. That first year, you can go ahead and deduct $5,000 in that startup cost, and maybe even another $5,000, depending on what the money was spent on. But let's say 5,000 for this example. So that first year, you're taking out 5,000. Or go ahead and deducting 5,000. Now the rest of the 45,000 is going to be amortized over 15 years. So that means that $45,000 is going to be divided by 15, and every year on your taxes, you're going to take a little bit of that 45,000 until it go ahead and reaches zero. Depending on the type of asset it is, you can accelerate the depreciation, or amortization. But with that, you want to make sure that you're speaking to a knowledgeable tax professional to see if you can accelerate the depreciation on it or not. Okay. Again, if y'all have questions, let me know. Drop it in the comment section. I haven't seen any questions come up, so I'm gonna finish up with the ones I have. I have two more. If I don't get any questions in the comment section, I'll let y'all go. Okay. The other one, next question is, what are the tax implications of selling my house? So if it's a primary resident and you lived in that home for 2 out of the 5 years, so say you own the home for 10 years, and then the first 2 years you lived in a home, the next 8 year or 6 years you rented it out, and then you move back into the property for 2 more years, then you can still use the property exclusion deduction. Now, say you own the property for 5 years, and you sell it, you want to sell it, or say you own the property for 4 years, you want to sell it, it still falls within the primary resident home exclusion, which means that $250,000 in capital gains, you can be excused in capital gains for. If you're filing joint with a spouse, then you can it moves up to 500,000. So if you sell a property and they gave you a check for 300,000 and you're filing single, then you're going to have some capital gains tax to pay on the difference. Now, if the same scenario, but you spent $60,000 on getting the property ready for sale and everything like that, you can actually decrease the tax capital gains implication. So that $300,000 gets decreased by the $60,000 that you had to put into the property to get it ready for sale. So that can help with decreasing your capital gains tax on that property. So you do want to make sure when you're looking to sell a property, you're taking note, you're writing down, you're keeping receipts. If you had to replace windows, doors, do paint job, do some pressure washing, but get a lawyer involved, whatever is cost that was associated with getting that property ready to sell, you want to make sure you track that, because that can help decrease the capital gains implication. But your capital gains tax could be 15%, depending on your tax bracket, the amount. It could be 15% of it. It could be 20%. It really depends on the amount and what bracket it fall under. And the last question I have. How can I lower my tax bill through retirement? Right. So if you have a Roth IRA, then you are being taxed now, or a Roth account, Roth 401k, Roth IRA. A Roth 401k is through a business or an employer. So it falls in that arena. Your IRA is just an individual retirement account that you opened up on your own. Okay. Now, if you do a Roth account, then you're being taxed now, not later. So when you go to pull the money out, because you were taxed when you put the money in, you won't be taxed later. So, which a lot of people like that, because, out of retirement, your income tends to fall. You want every dime that you can get. So being that, oh my gosh, like I want to take money out of my retirement and I had to pay the taxes on that too. Like, versus, I took money out of my retirement and I already paid the taxes on it. So I don't have to get hit with a tax bill again. Roth accounts are great. I like them. Now, the thing with traditional accounts, so that's your non-Roth accounts. Those you're taxed later. So it does give you a tax advantage now, because now you don't have to pay taxes on it. But when you take it out in retirement, you do pay taxes on the money that you take out when you retire. But right now, as you're contributing to that 401k or whatever that retirement account is, that's not a Roth, you do get to have a lower tax bill. If you're a business owner, then there are tons of ways on decreasing your taxable and tax implication on that, your tax bill, because you can set up a retirement plan through your company. The plan itself is a deductible expense. You're taking the deduction as far as what you're funding the money, as far as your the money that you're funding into your retirement. So these are decreasing your taxable income overall. So it does help with actually establishing a retirement plan through your business. Hopefully that helps. All right, y'all. So that is it. That's all the questions I have. Nothing in the comment sections. All righty, y'all. Thank you for joining me for another episode of Sipping Wealth Live. I'll be back next week with a new topic. If you do have topics or things that you want us to cover, feel free to send a direct message, drop a comment in the comment section. Let me know how you are any feedback you have on the lives. I'd love to hear it. But y'all have a wonderful, amazing rest of your Tuesday, and let's wealth up.